late 20s.
Okay.
Want to know, can I retire early? How can I retire early? Maybe at 55 to 60. Is that possible? Being in your late 30s or late 20s. Is it possible? Welcome to another episode here on our podcast series. We're excited to be back. And as always, it is a pleasure to have our expert in-house, Pierre Tomacek, with us. Good that you're here. Last week, we spoke at length of retirement planning. And one of the things you mentioned was, using an RRSP. And I think talking about retirement, just a great segue is to talk about an RRSP. A lot of people might hear the word, hey, are you putting money in your RRSP or contribute to your RRSP, or this is RRSP season. A lot of people don't know how it works, what it is, and how beneficial it could be. So I thought this week maybe just go simple on letting people know, hey, what an RRSP is and how do we use it?
Yeah. So RRSP stands for Registered Retirement Savings Plan.
Right.
And a lot of time people think they kind of think it's like the cornerstone of your retirement savings plan, and it can be, but there's so many vehicles that you could use to save towards retirement, and an RRSP is one of them. Now, having said that, we've got what is known as two types of accounts when you're going to invest. I've got extra money and I want to invest. There's two types of accounts that you're going to invest. It's either going to be registered or non-registered.
Right.
The difference, the thing about registered accounts is that it gives you some tax benefits.
Right.
One of them could be the tax-free nature, the tax-free compounding of when you're investing and you're making money with the investment. You don't have to pay tax on the income that you generate on an annual basis. And sometimes with regards to a TFSA, when you take money out of that registered account, especially with a TFSA, you don't have to pay tax. With the RRSP, when you do take it out, let it be 25 years, 30 years down the line, you will have to pay tax on that money. But the theory is that 20, 30 years down the line, you'll be in a lower tax bracket. So when you take it out, you don't pay as much tax.
So right now it's like an umbrella protecting you from the taxes. And then later on, when you do take it out, you're paying a lower tax.
That's right.
The umbrella disappears, but you're paying lower taxes. People contribute to an RRSP. How much should you be contributing?
Well, there's limits, similar to like a tax-free savings account. So you just can't
just take, I have this amount, I must put it there.
Oh, or else rich people, they'll just put
everything there.
Put all their money into an RRSP, defer paying tax until they have to withdraw it, which is the latest is when they turn 71. So the government stipulates limits. So TFSA, the limit is $7,000 a year. It's not as clear cut as a set amount when it comes to RRSP. It's based on your earned income. And it's basically 18% of your previous year's, last year's earned income. And earned income is important because earned income, think of it as employment income, generally speaking. So either I work for someone and they pay me a salary, bonus, and even sometimes commission, or I work for myself and I receive self-employment income from my sole proprietorship or partnership. So think of it as a salary or self-employment income. But what it doesn't include is investment income, passive income, such as interest income, dividend income that you get from stocks, and capital gains income. So when you sell an investment at a higher price, so let's say I bought Tesla for $100,000 and I sell Tesla for $200,000, I've generated a capital gain of $100,000. That will not be eligible as earned income when tabulating our RSP contribution.
So what about if I own a property and I rent my basement? Is that earned income?
Yes, it is. One of the rare passive investments, rental income, especially net rental income after all expenses, that will count towards your earned income. Now, 18% of your earned income. So let's say last year I made $100,000. 18% of 100 would be $18,000. But what if you make $200, $300, $400,000? They're going to set a limit. Last year, the limit was about $30,000.
Right.
Now, does everybody contribute the maximum? No. So one of the benefits of an RRSP is that the amount that you're not able to contribute carries forward, right? So hopefully later on, you'll be able to catch up.
Right. I just want to clear this. So let's say you have unused contribution, and you get more income, you add. But let's say you're still there. You're not getting enough. I know I heard this a lot. People borrow to put money into their RRSP. So can you borrow to fill up the room?
You can. A lot of the banks provide what is known as a catch-up loan or an RRSP catch-up loan.
Right.
Now, when it comes to debt, so there's that word called leverage.
Right.
Leverage could work, right? Leverage does work. It could magnify your gain, but it could also
you could lose.
Exactly. So you want to use it wisely. So definitely, most Canadians, a lot of Canadians, they do not maximize their RRSP because life happens, right? I've got to pay down my mortgage. Interest rates have increased. My kids are going to school. All of these things, so I'm not able to maximize my RRSP. So a lot of Canadians have over $100,000, $150,000 in RRSP contribution room that they'll never use. So maybe you could take out, say, a $50,000 RRSP contribution loan. One of the good things is that the banks is that they'll spread it over a 10-year period. So your payment won't be as significant. So you might have a $500 or $600 on a monthly payment basis to make your RRSP loan payment. You've spread it over 10 years, make it more manageable. But that $50,000 that you've provided as an RRSP loan, that will also be your RRSP contribution, and it will reduce your income by $50,000, thereby hopefully generating a significant refund. So that refund could be $20,000. So what you do with that significant refund? Don't buy a Tesla. Don't go on vacation. Take that $20,000 out and pay down the loan. So now your $50,000 loan has gone down to $30,000, and you could pay it off sooner rather than later. If you utilize that strategy, then leveraging, borrowing to invest, and using the RRSP loan makes sense.
Right, and then as you said, you could borrow, but then what you put into your RRSP could lose value, and then you still have to pay back the loan.
That is correct.
So that's the downside of it.
That's right. So therefore, what you invest the $50,000 has to be, conservative or balanced. So you may not want to be too risky, but again, it depends on the individual, your risk tolerance. So if you're able to withstand risk and you're able to take on a bit more risk, you want to be cognizant of the fact that risk could work the other way and the investment could go down.
So that leads me to my next question, because a lot of people believe, and I had this a preconceived notion as well, is that an RRSP has the word savings inside. So you just take the money and you park it there tax-free, and you can't trouble it. But it's not just that. There's strategies that you can use within an RRSP that is useful. What is, not letting out too much of Tom and Check financial secrets, but what is a couple of strategies that you use to maximize, your RRSP and the growth?
It's funny. It's funny you mentioned that, because even my older clients, and not just my younger clients, when I ask them, what do you have invested in your RRSP? They'll say, well, I have it invested in RRSP. I say, okay, what's the investment? The RRSP. No, the RRSP is just the account, right? Like you've used the word umbrella. Think of it as an umbrella. It's what you put inside the account. That's the investment. So depending on your risk tolerance, you could put so many things into it, right? So if you're risk averse, then you could put some GIAs, GICs. GIAs like the insurance version, guaranteed investment account. Or you could put some bonds, you could put mutual funds, stocks, ETFs. all depending on your risk tolerance. And by utilizing a variety of investment inside your RRSP, you could diversify and lower your overall risk and hopefully generate some positive return over the long term.
And that's what you want. You want to start as early as possible. As we said last week,
that's right.
Contributing to your RRSP important early on. And I think one of the other strategies that you can use is that, buying a house, as we spoke about weeks ago, very important. And you can take money from your RRSP.
Yeah.
Tax free.
That's right. The RRSP
is one of the occasions you can do it.
Home buyers plan. And then recently, with the last budget, the government basically kind of doubled the RRSP home buyers plan. Right. So now you could take out a whole lot more out of your RRSP tax-free and use it towards your first home, your first-time home buyer, if you're a first-time home buyer.
And so this really means that this is the time to work with Tomachek in order to maximize the use of your RRSP and make very good use of it and make it as you said, compound to greater heights.
Yeah, and it's not just Tomachek. I mean, we're here. One of the reasons that we do is to just educate people. Yeah. So if you already have an advisor, or if you're working with a bank or a trust company, by all means, speak to your advisor. Yeah. Let them get to know your goals, and they'll be able to craft a plan for you, the right strategy, because not everyone that an RRSP is suitable for.
Right.
And a lot of mistake is that people said, they'll say everyone should get an RRSP.
Right.
Not necessarily. Here's one of the things. If you could do both, if you could contribute to a TFSA and an RRSP, so be it. Do both if you've got the extra resources.
Right.
But if you could only do one, and you only have one job, right? So you don't have multiple jobs or part-time income, right? So you're working for one company, right?
Yeah.
And you don't have any additional income sources, right? Like side hustles,
right?
And so on. Then you're not going to pay taxes. Because your employer knows exactly how much money that you make, and they'll take the right amount of tax at the end of the year. So when you file your income tax, you will break even. Yeah. You might even generate a refund because of some certain strategies that you may employ.
Right.
So if you don't need the tax break, then put the money in a TFSA. Right? Because with the TFSA, you've got more flexibility. You never have to pay taxes. There are certain instances that you might, but they're very minute in terms of exceptions, and you could take it out anytime. Right? And as a result of that, you've got more flexibility than an RRSP, because once you put the money into the RRSP,
when you take it out,
if you take it out, there may be some withholding taxes that you have to pay if it's not for the home buyers plan or the lifelong learning plan for where you could take money out of your RRSP for your own education.
Correct.
Not your kids' education, but your own education. So you kind of, tied. Your hands are kind of tied in terms of the RRSP, whereby it's really you're focusing on retirement. Whereby the TFSA, sky is the limit. You could have a TFSA for education, put money in TFSA for retirement, to buy your Tesla, to take me out golfing, to do all kinds of things, and you have more flexibility there.
Definitely. And the point you're making there also that I picked up on is that when you contribute to your RRSP, you get a tax deduction, so that's good. And if you don't need it, then why contribute to the RRSP? So that's important. So we said last week that we're launching a new segment.
Oh, okay.
Right?
All right.
And that is Ask the Expert. Ask Tomachek. Right? So we did get feedback on that.
Okay.
So we've got someone who's all the way in Dundalk, Ontario. I think, I hope I pronounced that right. It's north, maybe somewhere to Blue Mountains, I think.
Oh, yeah, okay.
Okay. Blue Mountains, beautiful place. You want to go there? Pierre's taking me there, with his RRSP deductions and everything. But, late 20s.
Okay.
Want to know, can I retire early? How can I retire early? Maybe at 55 to 60. Is that possible? Being in your late 30s or late 20s. Is it possible?
Well, here's the thing. It could be, and it may not be. So there's few questions I'll need to ask. One of them, if you ever heard of SMART goals. So
specific and measurable.
So when a client is giving me a goal, whatever it is, to retire, to travel, to pay for children's education, SMART being the acronym, so S have to be specific, because I don't know what that means, retire early. What's early? To me, it could be 75, right? To retire early. We used to have Freedom 55, where a lot of Canadians wanted to retire at 55. So one, when do you want to retire? What age do you want to retire? Two, how much money you think you're going to need. So we need to quantify that particular amount. And then we could help you to figure out, because a lot of people are going to say, well, Pierre, I'm going to retire 25 years from now. I don't know how much money I'm going to need. Well, we could guide you in terms of trying to figure out how much money you will need 20, 25 years from now based on inflation. Another one, it's got to be realistic, right? So it's got to be realistic and achievable. So that way, if you're making minimum wage all throughout your working years, and you want to retire and generate $1 million a year every year during retirement, maybe that's not realistic.
Win the lottery.
Then 649. That's my strategy, right? Lotto 649, or going to the casino and going all in, right? But
I have 647. The phone number starts with
for Toronto area code. But for that particular individual, I would walk him through and say, it could be achievable. If you want to retire 55, 60, what will be important is to start now, right? Getting the plan in place now, so we could find out if you do have some surplus funds that we could utilize and put in terms of various investment vehicles, such as RRSPs, as we mentioned, TFSAs, and non-registered also.
Excellent.
That we could go.
Excellent. So there you go. We've asked the expert for you, and we'll continue every week from here on in asking the expert. So remember to like, subscribe, share, comment on our videos, and that's where we can ask Pierre directly about, whatever it is bothering you in terms of your finances. We provide that advice here for you. So hope we can catch you on the next one. Bye-bye for now.